Live now for everyone joining us and returning. We are changing things up a little bit. If you missed our announcement this last week, we are actually separating our shows into different content streams. That means that we're going to have specific shows for earnings, specific shows to highlight tickers that we like, called the earnings one is going to be Foliko earnings. The ticker one is going to be called Stocks to Watch, continuing forward with that name. This today is Foliko Live. So this is where we're going to be talking about a whole bunch of different things affecting the market. We're open to taking questions. We're open to starting up a dialogue, but this is where we get to hear from the expertise of myself, a career data scientist, and Tyler Tucci, who is a former hedge fund PM and now the head of research for Cinerai. So this last month, things have gotten crazy, just absolutely crazy. Now, I gotta say, I told you so. We told you so. I hate it when people bring that up. Hindsight is 2020, but our numbers were very indicative and very strong. Look at our episode, August 19th, and you're going to see us saying, hey, I don't trust this rally. I think it's going to throw up all the gains. And that's exactly what happened, because every indicator we had, all the numbers we crunch, I mean, we go deep with AI here. We're making models on models on models. We're bringing in data from around the world. We're crunching news sources. This isn't just us. This is numbers being derived from some of the most qualified financial experts around the world. And those numbers were pointing to one conclusion, and that was the market is not done going down. And so August has been a rough time. But the questions still remain. Where are we going from here? So I really want to bring in Tyler, because I always learn so much from you, Tyler. What is going on these days? It seems like everyone has just, with the first slide from January down to June, it made sense. There was a lot of overvaluation going on, some companies that were 100x times earnings and everything like that. And when the market shot down, where people were like, okay, I kind of get it. But from June to mid-August, we were recovering. It was looking good again. There was hope. And now I think I see a lot of depression, like out and out. Before the bulls, while things were going down, we're like, oh, but we'll head up. Oh, but we'll head up. And now I just see people quiet. So what's going on, Tyler?
Yeah, I mean, that was kind of a backbreaker. We threw up 2 months worth of gains in about 2 weeks. Very, very quick acceleration, 3% down after Powell. Really, I believe the word he used to trigger me to be like, okay, we're going for a ride. And the first sentence, he used the word forceful. And I think I sent about 4 or 5 text messages to a couple of my buddies on the institutional side, like, okay, fasten your seatbelts. Like, he is going to literally say the nastiest, angriest things he can to finally, slap the people who are taking risk into this backdrop in the face and say, okay, you think this is a good idea? Check this out. I'm literally going to let you know that I'm going to target lower growth. I'm going to accept less. And I'm going to tell you I'm going to accept less. So, adjust your positioning accordingly. And boy, we did. Boy, have we continued to. So that's
the point. Pain was the point. Pain was not the safety guardrails that everyone was predicting would happen, right? Because I think you've said this so many times, Tyler. You said the market is betting that 2023, the Fed is going to be shooting interest rates downward, right? That was the bet. And when Powell came out, 8 minutes, he said pain is the point, not the guardrail. Changed everything.
Yeah, and I think that's kind of what we and Foliko Data had been picking up is it's just we're just not ready yet, especially given that backdrop, right? If they're going to get rates to 4 this year, and we can expect a 4% policy rate for all of next year at least, I mean, that kind of changes your mind about a whole bunch of things, right? Especially, if you can get 2-year notes at, say, start getting a 4 or 4.5 handle, and you can clip a 4.5% coupon versus taking equity risk. Like, that trade starts to get a bit more interesting. Do you care to take equity risk? Are you happy at 4.5 or 5% in the top of the capital structure kind of really safe stuff, right? So that starts to get very, very interesting there, and you can't just plow into stocks because they're all alternatives when rates are higher. So that'll be the most interesting thing, and that continues to be the whole question. I mean, the 2023 Eurodollar part of the curve is literally the whole question in the market. In my opinion, will they, won't they, and that's the entire
Tell me
basis.
more
By
about that. What do you mean by will they, won't they?
traditionally, they talk all that good stuff, but like when it comes time, they're it's always flight, not fight for them. So the question is, are they going to watch things start to deteriorate? Are they going to look around and go, hey, this is bad, but guess what? No cuts. So that's the question is it's a blinking contest. And traditionally the will has not been there to watch risk assets take significant amounts of pain, AKA the Fed put. If there is no Fed put, who knows? And that's really ultimately the question is, where is the Fed put, and how serious is he in his conviction to, how much pain is he willing to inflict on the the economy and risky assets and 401ks and housing until he gets his way and he gets inflation lower. That is ultimately the question.
So I completely see and sympathize with the bear case in this. Fed is serious. But at the same time, I don't view Powell as a person with a plan that he will stick to no matter what data he receives. He seems very reliant on the data incoming. That's just my observation. But the data that I'm seeing these days, I mean, we look at, and we've covered this in the show before, we look at the three contributors to inflation: gas, food, and housing, right? I'm seeing a lot of hope on all three of these measures.
Yeah.
Food, the Economist was just putting out the other day, food has started going down. Grain prices, especially as Russia, despite everything, has still been shipping out wheat like crazy, right? Gas prices. We should go deeper into gas prices because I think that's a whole nest in itself. But housing, I mean, so yeah, Boise was up 60% over the last 18 months in housing prices, 60%. And now they've absolutely collapsed. I think inventory is shot up by in like the 30, 40, 50% in Vegas, Boise, everywhere basically that you could flee California with an easy drive, right? Like we left mom in a retirement home in California, so at least we can get back there. But now we live in Vegas. But in other words, I'm seeing hope on all these pricing levels. What does that mean, Tyler? Could we see the Fed starting to go a little bit more dovish?
Well, that's the question, and that is the problem is by the time we get enough data turning to confirm that they can stop, they will already have been there because the economy and this stuff hits on a lag. So that'll be the question is, and that's my biggest concern is that we've already fought forward inflation 6 months hence, but they're still reacting to today's data. So that's how you get kind of an accident. And that's my concern is even if this stuff still is moderating, they're not going to be able to turn on a dime. And that's the soft landing thesis. I just think there's not really a way to do it without completely capitulating on the rate. So that will be the question. Is are they willing to capitulate on the rate? Are they willing to say, go less than 50, for example? That would be a carrot to the market. I don't think they are, or they haven't shown any willingness to, and they need to, show that they don't care and they're willing to just go into whatever. So I think, they're trying so hard to use the stick that they might end up using too much stick, and that's really the big bear case for risk assets is that, yeah, sure, they know how to get inflation down, but they take everything else with it. Think about a move from 8.5% inflation back to 2%. Think how large of a move that is. Think about how large a move you have to have in stuff to get it back down there. Think about what stuff we're talking about, your houses, your stuff. So it's a very, very tricky ledge that they're out on, especially because they don't seem very sympathetic at the moment at all. So, when the moment comes, we'll see. And that's really the whole trade. But at the moment, forceful's the word.
So 50 would be, you're saying if they raised only 25 in this next meeting, that would be a big sign that they're starting to soften up, right?
Yeah,
But
by the way, not calling for that, but I'm just saying that would be something that I'd be like, oh, okay, hey, take notice, things are changing.
my 2 cents, tell me if you agree or disagree. I think in this next meeting, they have to raise to restore credibility, no matter what data they see. And I
That's
think that there's a big lesson for the Fed. They were raising 75 every time the market didn't even pay attention. Like it was a news cycle that ended 12 hours after the Fed raised it, right? And finally, Powell had to come out for 8 minutes, scream at people, "I'm super serious, guys." And so this next raise has to back up that super serious talk. Otherwise, they've lost all credibility, no matter the data. But I'm saying after that, I think that they could come in much more dovish.
that's ultimately the question: is how are they able to start to pull the plane up to land? Historically, the answer is just they don't. But hopefully we'll be proven wrong on this one. And that actually kind of that's a nice transition into. So somebody asked me last week, a pretty consistent watcher of this show, why I'm always looking up. So I have live pricing always running up here. I'm watching something that's going on. Currently, it's natural gas. And I will be letting you know what.
You can't abuse the lower thirds like this, Tyler.
Oh no, I'm going to be the John Madden of the lower thirds. You just watch. But so this is kind of what I'm thinking about. This is the thing I've been watching really the last 2 weeks, but in the last 72 hours or 96 hours, I pretty much watched every tick from the close of the futures Friday to the open, even though the market's not open today. Very interesting. So this is something I'm short. I own puts on UNG. I own weekly puts. I was short last week. I rolled those. I took profit and rolled those. So now I have more puts. I'm also short a natural gas company that I'm not going to talk about specifically here. But it's very interesting because Russia shut the taps off completely overnight. And if you'll notice, prices are lower. That's not the kind of news that is bearish for natural gas in of itself. So I think this is very interesting to me. These are things that you want to watch because this is signs of a turn, in my opinion. So these are some of the best trades because you can get a nice trade on the acceleration out of the top. I mean, I think technician's delight here, divergence on the second high, all sorts of crosses. I could go on for an hour. I won't, but I think this is, in terms of trade ideas, this is my best idea. This is what I'll be looking up at this week. And that's part of.
If you don't mind me just jumping in with a quick question here, is this to say, if I'm understanding you correctly, that everyone threw as bad of a view as they possibly could into natural gas, so that now when Russia's thumping their chest again, everyone's like, well, that's already priced it.
Yes.
So as negative as we possibly can.
Yes. So it's the economist cover trick, right? So I think it was 2 Fridays ago, they came out with the cover was the coming winter energy crisis in Europe. So generally, by the time those things hit the front of the magazine, fully priced, fade. There are books I'd recommend literally that are just like, you don't need to know anything about math, don't need to know anything about technical analysis. If you're good at reading sentiment like that, there's plenty of places, spot in the market for you. I know some people who are excellent at just reading the prevailing breezes and realizing when they're ending. But yeah, natural gas, I think it's kind of game over on the upside there, which will be very interesting because to Travis's point, that would be a good thing. Cold and hungry is the worst possible outcome. If you look back through history, cold and hungry is when bad stuff starts to happen. So to the extent that we can, eliminate cold, that's positive, right? Obviously, at the being, talking about purely the economic backdrop here, and no way, laughing at anybody's pain, but that would be a welcome sign if we can get natural gas prices kind of back down under 7 or so. That would be a very welcome change, and I certainly think that's on the way. And if that happens, this is the kind of thing that allows the Fed to start being more dovish. If energy prices are coming way off, if housing prices are coming way off, this is how we get sequential inflation to start to print negative and kind of get this whole thing under control. I will remind everybody in Foliko or Cinerai Quant now, we found that the bottom in risk was coming this month. So that's going to be a really interesting one, and we're going to Travis and I are going to talk about this next. So there's three possible outcomes in my opinion. So we just had outcome one. We just had kind of a tantrum based, after Powell and positioning. It's fine, buy the dip, bottom, right here, right now. Kind of outcome two, we retest the June lows and bounce. Okay. Outcome three, we just failed on the underside of the 200-day moving average, and we're just going to get completely unhinged. We kind of caucus with the second one. We do think there's a chance of some further tactical bleed, but I'm not really sure that we have what it takes to get down to 3,000, say. Do we? I have that as the last level of like ultimate support. That was, I believe, the breakout in 2016. But I don't necessarily think we have the juice for that. It's kind of more like back to 37.50 and up. According to our analysis, we have no problem changing it. Maybe we'll do another Cinerai Quant in a couple of weeks and refresh that view. But after the adverse volatility of the last 2 weeks, you kind of got to make a call here in terms of, okay, stick my feet in the ground, buy it now, pick a level to buy it, or you just think, you're out and out short and, you don't want to be touching longs, at all. I don't think that's necessarily the case. But I do think you still have to be careful in the weeks coming up. So there's two sides of where you should be careful. So one, and this is something that I've been kind of, beating some of these names. So this is UNG is the natural gas fund. I'm not shorting it via futures because I feel like sleeping. So the other one is XLV. That's the healthcare ETF, McDonald's, and AbbVie. If you notice, all these names are close to or near highs or were. And this is something I've been talking about. The third leg of a sell-off is usually the more quality stuff and not the the really specky stuff, the ARC names. I mean, how much more wind can we take out of those sales? I'm sure we can take out some, but just in terms of when I think about risk reward, where is it? It's better in names like McDonald's, where people have been hiding out, and there's nothing nothing bullish in the backdrop for McDonald's.
That's exactly right for me. I just to hone in on McDonald's for a second, because I've been thinking through this. Ever since I took my daughter out there, bought some simple chicken nuggets, and we were paying $30 for a meal. This is not the recession-proof stock that I used to think of it as, and I think that everyone has flooded into that and energy for safety. Just buy something, and if the economy craps out, at least you've got McDonald's. I don't think it's there anymore. So this is something that I'm really in agreement with you on. It burned everything with this last earnings. I think everyone was looking for this to be bearish on the last earnings cycle, but I could see it giving up some position here for the next earnings cycle.
Yeah, absolutely. I mean, earnings power, not so good. Competition, not so good. And that's a problem all of these fast food places are facing. Burger King just had to increase the price of the Have It Your Way meal, and I think it's now like $6 or $7, which moves it away from the $3-4 value to, okay, this is just a fast food meal. There's no this isn't like a ton of calories for a very cheap price. This is a ton of calories for a very high price at this point.
Is that because the Burger King Have It Your Way meal is them running out and buying a McDonald's meal for me? That's really my way.
Pretty much. But the other interesting thing I wanted to talk about was Before the show, Travis and I were talking about the danger of analog charts. He was looking at the chart of 2000 and how basically we started to get unhinged in September. And I warned that looking back is a way to gauge the bounds of outcomes and not a way to predict a single outcome. So the people who use
Well,
I've seen the,
let's go through this real quick. Let me just point out the same thing that I was pointing out, and so we can have people walk along the same journey we did real quick. So, look, what I was noticing is we've got this downturn since early 22, and the rally from mid June to mid August, and then just absolutely falling down. And the question is, well, what is possible going forward? You know, could we go and just completely exceed the down point from June? What is the range of possibility? So I was looking at past historical examples, honing in on 2008, and if you look here, 2008 saw something that was it looks pretty similar to where we're at right now. So you have these highs, they charge downward, and in March, April of 2008, there's this great rally. And if you were here on April 28th of 2008, you would be saying, look at all those stupid bulls that were saying we would go down below even 1200, and we've recovered. Now we're out. Everyone buy, risk on. Great, going forward. And they went from there down to terrible, terrible, terrible lows in early 2009. So the next year after that was just absolutely atrocious. So my point being, I was looking at this and saying, are we jumping in too early by saying this could be another low? Uh, and that's where our conversation was going. So go ahead, Tyler.
Yes, and that's the big concern is they just pull the floor out from underneath you. So the thing that drives me crazy, I've seen this a bunch. People like to overlay the 2000 Cisco chart with the current NVIDIA chart, which yeah, sure, I appreciate that there are some similarities there, but using one to predict the others with real money is completely insane. But
Well,
that's
it's not apples to apples either, though, right?
right.
Like,
No, it's a random. You're that's like back to the monkeys throwing darts at barons and seeing performance, right? Like that's just some random stuff there. But you had made an interesting point that I want you to talk about again because I think Nvidia was such a darling. People made so much money by the double digit holders of Nvidia made 4, 5, 6, 7, 8, 9 times their money on an equity position in a decently short amount of time. So what is now the thing that's changed in your opinion that you really don't think is fully appreciated yet?
yeah. So look at the tech side of NVIDIA, and this is where we take off the stock market hat and we go looking more at the tech side of things. NVIDIA has been powered by being some of the best in class GPUs in the world. So what has that been used for? That's been used for video games and data centers, right? Now, NVIDIA loves to push data centers because coming out of COVID, people are going to have less times for video games. And so they're just going to be doing that less and less and less. Now you can actually get an Xbox Series X off the shelf, no problem, right? For years, that's been absolutely impossible. So gaming is starting to decline coming out of COVID. And so NVIDIA is like, oh, no, not gaming. We're really into data centers. But hone in on what's going on in data centers. A lot of that has been crypto mining. And a lot of that crypto mining has been happening in China. And so now on Thursday, the US government is coming out to NVIDIA saying, hey, all those GPUs and all those AI chips that you make and stuff like that, yeah, don't send those to China. So if you're comparing this to, it was Cisco, Tyler, in
Yes.
2000. If you're comparing this to Cisco in 2000, was the US government going to Cisco and saying, hey, your biggest market, don't do that anymore? No. So you're thinking about NVIDIA being this darling that it has been for the last decade plus, right? It's not going to be that anymore. Now, I love NVIDIA. I love their chips. I think it's fantastic, but they're not the same company that they were 2.5 years ago. So if you're expecting them to, oh, great, we're back in a bear market, NVIDIA is going to go back up to where they were. They're deserving of the multiple that they had in 2019. That is not the case. I don't see that ever happening, not without some mega revolution in technology piece. So, but I think it's the same if we're comparing again that dichotomy between Cisco and Nvidia and the S&P now versus the S&P in 2008. The S&P in 2008 had so many structural things that were different from the way they are now. Housing needed to completely change fundamentally, right? Do we have
Yes.
those same pressures? Because I
No,
do.
and in the housing market, no, it's not even close. Like when you look at, what basically what the average person has borrowed, I mean, it's just not even close. I mean, we're talking about people, are they too leveraged on their one home? Yes or no, as opposed to are they leveraged on their, four and a half homes, right? That's a whole different question, right? So that
What
we
do you think of this, Tyler? Real quick. Anytime you see mid 20-year olds that flunked out of college making millions of dollars, that's a market you should be shorting. And that happened in housing in 2008 and it happened in crypto now. That and that's where
yeah.
all the froth is, right? Wherever 20-year-olds are becoming millionaires, that's a market that you got to be saying, okay, we got to let air out of this.
Yeah, no, that's interesting because there's a lot of people who are comparing what's going on in tech right now to what went on in energy in 2016, where it
Mhm.
was just like, they just ripped all the excess out of, because you can't afford to buy everybody green juice once you have to fund it 10%, not 3, right? You can't have office smoothies anymore or whatever. So it's kind of the same thing where the demand for the underlying has reached such a saturation point or has decreased that there's no more growth. So you have to make real decisions because it's now about like where can you produce cash flow, not like can the time sales question part of the cycle is over, where you could value things at time sales. That's and that's kind of how it works. Is the metric we use switches as our risk tolerance shrinks and grows.
We are coming up at our half hour, Tyler. So I think in this time we've covered some really cool things just about the market in general. One big question that I have, and I think that we should do a quant on this to go deeper on it, but I've got a huge question on housing. I do think that there's a bet being made right now, and Labor Day today is the hinge point. A lot of companies have had their employees out there in remote work or I would say extenuated hybrid, where it's like come into the office once a week and no one actually comes into the office once a week, right? I think Labor Day has been the deadline for a lot of executives to say, no, you're coming back. So a lot of these depressed housing markets like California and New York, where people fled for lower housing prices, right? Let's get the home office this time instead of having all 5 kids in one bedroom. Let I think that now is going to be stressed and stretched a lot. I would look for housing in the subdivisions around cities to start to equivocate to housing inside of cities. As people say, I only need to go in once a week, so an hour and a half commute, I can live with it, right? So that's going to be a big shift. But you're looking at places like Boise, Idaho, Las Vegas, some of these, I would say, not not core job center cities. I think that's where we're going to see a lot of air being let out of the tires. If companies can make that remote work actually shut it down a little bit, right? But if they don't, there's a lot of real estate that's been held on to in California and New York on the idea and promise that the market will recover when companies make their employees come back. This is that hinge point. And I'm glad I'm not invested in either way because California and New York might have real estate repair and go back up to old levels, or they might shoot downward as all the investors realize they're not getting their capital back. Thoughts on that, Tyler?
Yeah. Oh gosh, we're doing a center at Quant on housing. There's just so much interesting stuff here. There's I was I guess a popular one is basically if you missed the move in real estate, people are now like Missouri is a popular one. I guess the rights for landlords there are most favorable in the US, or like just yes, because there's just so much crazy stuff going on. I actually think that there's a case that this is just a small dip in housing and it's going to head higher, which is actually, I think, an interesting take, and I will support that with my historical case when we do it. But yeah, there's a very wide array of outcomes that have, I mean, obviously massive implications.
Awesome. Well, let's dive into it. You're going to see our show announcement coming out for Cinerai Quant coming up. I think, Tyler, can we confirm? Let's do housing.
Yeah, we're going to do housing. We're going to try to do it this week, but this is something that takes us quite a bit of legwork. So if we can't get it to you this Friday, look for it next Friday.
Great. Tomorrow we're going to be coming into Foliko Teach. That's where we're going to be going into a lot of the numbers that. So in this show, we don't have time to be teaching. Here's what this number means. Here's what this trend means. But that's important information, and we're going to be sharing out all these screens for free through Foliko Lite here very soon. So we want you to be armed with all the tools that you can be and all the learnings that we have to use our data to the best of your ability. That is tomorrow's show, Foliko Teach. Tune in tomorrow, roughly around the same time. And we'll see you then. Thank you, everyone, for joining. Please, if you have any comments, thoughts, or questions, we love to answer those. Just send them anytime. Bye all.